So we have a pretty good idea now how to trade in trending markets. We have our structural areas and our swings. We trade back in, we take longs, or we trade back in and take shorts, either way. Happy days. Easy enough. Areas to risk off of, areas to invalidate our theories, and away we go. But as we know, the market doesn't just trend all the time, either bullish or bearish. So we have to look at the concept of ranges. And when we're looking at the concept of range-bound environments, there's two key factors that we need to be aware of. Number one, we need to study and understand whereabouts the ranges are likely to form. And number two, we want to be able to spot them as early as possible when they occur so that we temper our expectations out of the areas that form internally inside of them, so that we're not expecting violent movements to occur one way or the other. Or at least to have the idea of what we call a change in personality, where the market will tip its hand that it wants to break out from one side or the other, and what that looks like. Because we definitely don't want to be getting in the way of an expansionary phase once the range starts to expand. So with part one, what we're looking at in the areas that ranges tend to form are areas of high indecision. So we'll typically find them right above key structural lows or right underneath key structural highs as the market builds SNDRs typically to then run them out. And institutions will swap their positions inside of these areas without affecting price too much, as we've already learned. Or ranges will form after we've taken out structural highs and lows. And by that I mean typically on your higher time frame, you'll see ranges form after we've broken out, because people will be taking profits heavily after we've just done that. People will also be buying the breakouts. They're not quite sure if it's going to continue on for another 50 or 100 or however many points, or if it's going to fail and create a wick and now trade it back into the zone, right? So that creates indecision, and when we have an indecision, people tend to buy low, selling quickly, or shorting high and then covering very quickly. So we'll get into some examples in a bit of some higher time frame range-bound expectations. But first here, what we're looking at is we have this area of interest that then broke out here. And you see this low that was formed. Clearly we're in a range in this environment, but how do we spot it? What's our initial idea where we can start looking at if we're going long somewhere internally? Then how do we know whether to take it off above this high rather than expecting a breakout above here? Equivalently, if we're going to short off of failure, then we're looking at this key area of interest. Okay, this makes sense to us. We've got a key protected high that we're expecting to trade back into and then continue on. But what do we have? We have this valid low that's formed here, right? We validate this low. We then trade into our area of interest, creating a valid high. Okay, everything so far makes sense. We're tapping into these areas of interest and unloading. And then we create a valid low here, right? So now we've got a valid high and two valid lows inside, none of which is breaking structure in any way, shape, or form. This movement goes up. We expect it to fail in here. And once that failure occurs, especially once we get a confirmed high in that move, we're now definitely inside of a range, right? We're expecting that this range movement is going to get chopped around inside the middle. So the first warning and the first sign of caution that we have inside a range is that we stay out of the middle. We want failure on either side, because ranges don't operate on the structure of trend as we know it. Ranges operate on liquidity principles. They will be searching internally for liquidity, as you see in areas like this. This movement finalizes its movement down inside of the middle. It then runs up, and it actually tries to take that high but couldn't, eventually coming all the way back down here. And you'll notice this movement doesn't break this low either. Why? Because everybody that's short up here is taking their profits quickly with the understanding that we're inside of a range-bound environment. So we look at this failure that's going on underneath here twice. This trades back up, right? We then get failure above here as everybody's taking their profits when they can. And this will continue inside of this range-bound environment and so on and so forth until we have something called a change in personality. And what I mean by this change in personality is that we have strong full body candles that are pushing either side. This trades up to the top of this range. It then trades down to this range here. We then trade back up. We then trade back down. We then trade back up, etc., so on and so forth. We expect the markets to have inertia that we do something similar to this, right? With each and every extreme of the range, we expect, until proven otherwise, that the markets will revert back into this range here, as we expect anybody shorting to cover and anybody buying to take their profits as well. And when we're looking for this to be disrupted, usually the market will tip its hand. Usually you will have either one side run out. So in this case, we would have, say, this movement would run all of this liquidity, and we call that manipulation. And then we would have the actual move that would come in after that liquidity is run. In general, when we have a bearish move that then has a range formed, we usually expect to run out the low, calling this manipulation again. We usually get some form of failure, whether that comes up and then we get a sweep and then it actually delivers the higher time frame movement up, right? But either way, we're looking for failure to then trade back into the range here, as there was a lot of business done. So there's a lot of volume. And in general, that's what we look for ranges. We look for the accumulation, the manipulation, trading back into it, mitigating itself, and then deciding what it wants to do. If this movement is extremely higher time frame, and you will know based off of how violent it is, then we expect that this is manipulation and we're actually going to clear all of this and then end up taking the high that put this range. But digressing for a second, our strategy in range-bound environments is twofold. If you're a swing trader, then you're looking for that manipulation to happen, for price to tip its hand and then to ride the momentum that occurs. If you're a scalper, you're looking to trade the extremes back into the midpoint of the range. So you're looking for failure on either end, say somewhere in here. You're looking for failures to trade back into the midpoint of the range. Or you're looking for failures that occur in here to trade back up into the midpoint of the range. So zooming it ahead a few bars, what you're looking for to avoid is you're looking for something like this. We have our failure here. This trades up. You'll notice we don't have these cataclysmic bullish candles that are coming in. This is a bit of a different change in personality here. This traded up from the midpoint here, failed. This was a violent movement that then failed as well. But this movement, we had some sell-off here, sideways. We then had this movement strongly closing on its low, and then this one followed suit closing here. So what we're looking at now is that the market has changed from its dynamic and what's going on here. We have strong wicks, all of which taking liquidity and had a strong rejection. This one is a full body candle closing on its low. Even though this took the low, it's not really relevant in this case. We're looking at the drive here that had no significant buying that took place afterwards. So we're looking at this as a change in personality. We had something happen. We now have something very, very different. That signals to us that something different is happening. And as a result, this actually trades lower, taking this liquidity, sweeping out all the longs that were in here. And then what ends up happening, as you can see by the higher time frame, we blast off. Not closing underneath this low. This is all manipulation, which leads to a very significant distribution move. So circling back now, just to reiterate, when we have lethargic movement on one side and then the opposing side, we can expect, once we've created valid highs and valid lows, that we're inside of a range and we're looking to trade the extremes of the moves. We're not looking to play for a momentum move, getting long in here for this liquidity move, or shorting here for this liquidity move, right? We're staying out of the middle and we're fading either side until proven otherwise with a change in personality. So in this example here, as you can see, We have a higher time frame low. We came up, we traded lower. We couldn't break it here, leading to a base and a large rally. When we returned back down into it, you'll notice we based here, going sideways, not validated. We validated this low. We then traded sideways, sweeping above this high, trading lower, sweeping underneath this low here. And this movement back up, we start watching inside of this range-bound behavior, which we're going to look at in a second. And we're looking at this high, which we cannot seem to trade above and close, right? Inside of our range-bound behavior. So now we're range-bound right above this higher time frame area of interest in our expectation, unless we get a major failure that occurs here, is that we're going to now run this low, and this is now functioning as an SNDR to do so. So when we drop down to our lower time frame, we can see inside of this movement, we've got structure forming, which then has failure above. We then trade lower, trading immediately back in. But here's where things get a little interesting. When we understand that if we cannot close above this high here on our higher time frame, we have this low that puts in this high. And that failure here determines us now breaking order flow, and we're expecting to trade back into this zone. You'll learn a lot more about this in the narrative module and the multi-time frame analysis module. But we're starting to pair together this range-bound price behavior where we're looking at taking trades on extreme price movement and trading back into the area of interest, which is the middle of the range itself. So instead, we're now building our SNDR lower, and we're looking for shorts at the top of the range here to potentially break that higher time frame area of interest. Or we're looking for failure that then occurs at the extreme on the downside to then trade back up into the midpoint of the range. Now, what you want to be careful of when you're in range-bound environments is trading based off of a momentum like this. This worked out here, obviously. But what you often find is taking short positions off of failure based off of momentum and not liquidity. And then that actually gets ran as it takes more liquidity on the other side, right? You have to be a little bit more aggressive with these trades, taking your stops as they come, and then trying to fade the movement back in, knowing eventually you'll be wrong. And that's just how trading works, right? Not every single movement to be faded is going to make money. Many of them will. However, we're looking as a strategy to fade the external areas back into the midpoint of the range once we've identified this area having a valid high and a valid low pertaining to the time frame that the range is on. For example, this movement here, if we go back to our 15-minute chart, we notice that we have a valid low here, which isn't generating any movement back up, and it's certainly not generating any movement back down other than this failure. So we're looking to trade either side. We notice a few different things. Number one is we have a higher time frame structural high here. So if we're going to break it, we would expect when we trade up near it, we would have a range. We call these ranges SNDRs, as you guys know. And their purpose is to break out, right? So as we get close, there's indecision, market deciding if it wants to break it or trade back down, or if it's going to fail, right? So the institutions are taking some profits here. They're exchanging some shorts for longs, or they're taking some profits in here before it gets ran. And what ends up happening after it gets ran is you'll notice we actually have a little bit of a range here for a few days as well. The market then decides here that it's going to trade back into this SNDR, leading to higher prices, right? So range is formed here, and then immediately after we break this high. Now, other than that, we see other ranges formed in here as well, as we have protected lows that are formed. We then have ranges right above them, which lead to breaks in structure, creating a new trend, right? And as we create more ranges, we then break these protected lows, leading all the way down until terminus. You'll notice this is actually the origin of the move here. Now, this one is quite significant as well, as we had a range that then formed and broke this internal high. And you guys will learn about SNDRs that break SNDR later on. But we have multiple ranges in here that we can then spot and anticipate, right? We have this violent movement that came from this low, another violent movement that came from this low, and then we enter a range as we're approaching this high. So expecting any longs in here to yield significant price movement is lunacy, because we're expecting a range to form before we take this high, right? Whereas once we break structure for your first one or two swings, this is where the violent moves happen. This is where we don't short trying to expect continuation of this trend, or else we get our faces melted off, right? We want to take these first two swings for violent movement, and then we want to temper expectations after that.